good afternoon, good evening, depending on where you might be. If anyone can hear me and see the screen, if you could type something in that question box and let me know we're coming through okay, that would be helpful. Little sound check, if you will. It looks like I'm okay on this end, but I never know until some brave soul out there says something to me that we're doing okay. Yeah, now it's coming through. Good, good, good. Thank you, thank you, thank you. I do appreciate that. Always nice to have a lively crowd around here. Little introductions. My name is Roger Tricco, and I will be presenting today's program from Forex.com. This is part of their Foundations in Forex webinar series. Today's program is entitled Using Breakouts to Help Predict Market Moves. That's a mouthful. Hopefully we'll break it down a little easier than that and give you some ideas of how to look at things. This is an interactive webinar, as we already have just done. Thank you, thank you. So if you have questions on anything being presented, please go ahead and type your questions in the question box, and I will be happy to answer your questions. Also, at the end of tonight's presentation, I will stick around for a few minutes in case anyone has questions on what it is that we discussed today. Always want to make sure that you understand the material before we say good night. With that, we do have to keep our legal department happy. And we therefore, let's see, come down here, we have to share a couple of disclaimers with you. Even if you've seen these before, I do recommend reading them. There is some good information in here, some pearls of wisdom, if you will. So I highly recommend that you take advantage of that and read through and see what it has to say for you. And repetition is always good as well. We do have our first question. Does Forex offer mentorship? Not that I'm aware of. Obviously, they do offer education, but I'm not aware of any mentorship. You can always call customer support and ask them. A couple of moments here. Da-da-da-da. Some of the bottom gets into some legalese, but there's some good pearls in there. The big one, do not invest money that you cannot afford to lose. You can't put a match to it, don't trade it. Give you another moment here. All right, I think we would have had time to get through our first disclaimer. Let's move on to disclaimer number 2. And this one again, stressing that tonight is for educational purposes only. I'm not a broker nor an advisor of any kind, and therefore do not recommend any particular market. As mentioned, we'll obviously be looking through a number of different markets tonight. It is not meant to suggest that any of these markets are the end-all, be-all of trading. Whatever markets you choose is a personal decision, as I always like to say. You choose those markets for whatever reason that works for you. And that's what counts. No right or wrong. I'll give you another moment here. Mhm. All right, I think we would have had time to get through this first disclaimer. So with that, let's move on. So what are we going to talk about tonight? Well, here's our little agenda. First up, the most effective breakout trading strategies and how to turn theory into practice, and therefore the live markets. Number two, how to verify breakouts and avoid succumbing to market misdirection. Number three, whether the euro, the yen, the pound, or the CAD dollar is the best candidate for a Q2 breakout. Uh, Side note here, spoiler alert, I am not here to tell you what to trade. um, I don't see the future. I don't have the crystal ball. I'm going to share with you some thoughts of how to read the market so that you can make your own best decision within whatever markets that you are trading. All right, back to the program. And lastly, how to use the Fibonacci retracement levels to enhance your thesis and increase conviction. All right, there we go. How about that? Live market demonstration. Let's go to the charts. My kingdom for a chart, as they say. And there we go. We have a chart. Actually, I'm going to change this. I'm going to go to, let's move this out. Let's go with the full, there we go. And just right. All right, and let's see, I need to go to date, start with the date. All right, just so that I can follow in my own notes along here. So the first thing that I'm going to share with you is the last thing on the agenda, and that is the fib retracement tool. We use the term fib as opposed to Fibonacci just as an abbreviation, like so many other things, so that you will hear both used. As the name suggests, retracement tool, this is designed to help you, and very important here, in a trending market, very important that it is that this tool is only used in a trending market, to help find retracements, meaning markets go in the direction of the trend and then they retrace. Clarify that. So here we have a trend. Here we have the market going in the direction of the trend and then it pulls back. This is the retracement, the pullback, the counter trend, whatever you want to call it. So that is what we're looking to measure in the future, where after a move in the direction of the trend, as the market starts its retracement, how far back might keyword, might this market move? Now, just because you put a fib retracement outlay on a particular market does not mean that it's absolutely going to pull back to that point. It may come short, it may go long, it may be perfect. So just be aware that like any other indicator, I don't care what it is that you're looking at, there is the potential for good, bad, and indifferent. All right, with that. First thing up, side note, I use the crosshairs. It allows me to key in vertically on a particular candle or horizontally look for support and resistance, which is one of the things that we will be looking for today. The crosshairs is located up here at the top under the cursors. Click on cursors, you see the cross, click on that, and that'll give you the crosshairs. Folks, little side note here. I am going to show you how I do things. If you like something that I do, you are obviously free to take it. If there is something that you are doing currently that you prefer versus what I am doing, I am not offended. Trading is all about you. However it is that you do things is what's right for you. So anyway, with that, I use crosshairs. All right, now Fibonacci. That comes down here. We click on here. We scroll down, and we see fib retracement. The lot. This page would be over here if we had Fibonacci retracement on there. So we just shorten that to fib. Click on that. This turns blue, and I'm going to open this in a blank page just to show you what's what. All right. This is designed for an uptrend. I start at a market low of a move, and I go to a market high of a move. And then, let me get my, so here's a move, here's a move. I'm measuring this move. What we're now looking for is the retracement. How far back is this market going to go? The sweet spot is the 50 and the 618. Now these are all percentages, so that when a market pulls back to the 50, this is halfway between here and here. This section equals that move, okay? That's the 50. This is 61.8% of this total move, okay? This is the sweet spot between the 50 and 618. We are anticipating that the market is going to pull back somewhere in this range. Maybe a little bit short of that, hopefully not anything longer than the 618. But that again is the sweet spot. If it only pulls back 23%, or that back to the 236 level, that's a real shallow pullback and has not given the market enough time to shake out the weak hands or people who have just made their money and said thank you to the market and moved on, et cetera, et cetera. So again, this is what we're looking for in that area. Now, if I go back to this and get rid of that, go back here and I'll show you the down move. So this would be the same thing in a downward trajectory of the market, a down market. And as a side note, folks, that is one of the great things about the currency markets, is that we can trade to the downside just as easily as we can to the upside. Hence, that's why we have a sell and a buy sticker up here. We can go quickly to that. Unlike the equity market, where we typically think of buying only to the long side, and it's a little bit more difficult to sell short in those types of markets. The Forex market is that much easier to do. So I want to try to share with you some of these markets where they have good trending down markets. Now, the advantage of that is that it increases the opportunity for sales, or for trades, I should say, for us as traders. So with that, I encourage you, if you're not comfortable with down markets, is to start working with down markets to train your eyes and your minds in that direction. Whatever you look for in an up market, it is a mirror image to the downside. Just flip it around. That's all it is. All right. With that mirror image, we're looking once again the sweet spot. Get my brush out here. Sweet spot 60 to 50, 50 to 618 is our sweet spot. So market comes down here. We're looking for it to pull back into this level somewhere, to this price range. If it gets close to that 50, maybe that's where you get your entry. And if it pulls back, that's okay. You accept that, you hold through it. As long as it doesn't break up through here, then you're okay, because that's where you want to put your stop loss based on the chart. Somewhere back here, maybe even to the full retracement back to this point, because if price goes all the way back to here, we've done a round trip. That's 100% of the move. And if price goes beyond that, this is where we want our stop loss, perhaps, unless you have another strategy that's different. I'm not here to tell you about that. But that's your stop loss, because if price continues to go in this direction, we want out when we thought we were going to the downside. All right. So always, always use a stop loss. Very important. It will give you a peace of mind. It will tell you that monetarily you have set this amount of money, whatever your currency is of choice. It tells you that you have designated this amount of money that you are prepared to lose and not more. So there's the benefit of a stop loss. Let's keep that to that. Erase this. Okay, whoops. Got to go to my crosshairs again. There we go. All right, that is fib retracement. Again, using it only in an up market. English teacher would be happy with my corrections. Hang on a second. I need a little sip of water. Okay, fib retracement in real life. Does it work? Yes, it does. I am here to share with you. Here's an example. I'll give you an example up and down. Here's an example of an up market. So I go here, click on that. It turns blue, which means it's ready to rock and roll. And let's see, where am I here? Down here. So I go to the bottom of this candle. This is where that crosshairs comes in. So I'm sure that I'm keying in on this candle. So here's the move up. Here's the pullback. Here's where I'm starting. So I'm starting here, and I'm going to the next high point. Then I pull it across, because in real life, this is what we're looking at right there. That's what we see. We see that the market moved in that direction, and it peaked and potentially is starting to pull back. So then you put on your fib study, and just as I did with the blank slate, it's going to be in the white area. And then we're looking for that to pull back. And if I can make this a little easier for you to see, there we go. So here's my zero line. Well, down here, here's my zero line. Here's my top line up here. And look at that. Here's the 618. Small breakthrough, but that's okay. Worked out beautifully. Nice, beautiful move. You would be very happy if you caught that particular move. All right. Oops, that. There we go. Get rid of that. Oops. Come on. There we go. Okay. Now let's show a down market. Let's see, November 4 up here. So we start. Let's see. We can pick our tool. We start at the peak, and we go down. Wait a minute. No, it's not right. Yeah. 29 down to here. Right there it is. There it is. And we draw it across. And look at that thing of beauty. Let me, whoops, bring that up a little bit more. Trying to get those, they're covered in there. Anyway, we can see here's our starting point. That's our zero. So if it comes back, if price comes all the way back to here, that's 1 or 100% of this move to the downside down to here. Here's my end point. And we pull back. Here's the 50. Here's the 618. Look at that, sports fans. Beautiful. Textbook. Couldn't draw it any better than that. and then we move down here, hold through that pullback, or you get out, whichever your strategy calls for. If you hold through, that would be, my goodness, thing of beauty right there. All right, so there's our fib in action. Let's get rid of that, go back to that. Okay, that's our fib tool. So that looks very nice. Oh, I know what I'm trying to do. Get this. Let's squeeze that back a little so we can see some good stuff on here. That's one of the things I really like about this platform is you can just mess around with it and make it the way that you want it to be. That's nice. Personal opinion, I like that. Oops, I went too far there. Trying to get that to show as much as we can for you. All right, there we go. Let's look at, support and resistance. Now, support and resistance, you will hear, if you haven't already, you will hear many people using different concepts for support and resistance. What I use is a horizontal line, and therefore my crosshairs come into play. So I look for flat levels where price has rejected a minimum of 2, but the more is the merrier, as the saying goes. And the more the merrier comes into play here in that the more times that price is rejected from this line, let me put this in. So I come up here, click on Trendline Tools. Now I like horizontal lines because it goes in both directions ad infinitum. So let's see what we got here. That looks good right there. And folks, if you don't like that color, choose the color. You can choose the thickness of the line. You can choose the style of the line, et cetera, et cetera. There's no right or wrong. Okay, so I've got a touch there. Now, when price is below this line is considered or is called resistance and it acts like a ceiling. When price is above the line up here, this same line is now called support, and it acts like a floor, preventing price from going through, not obviously always, but until we're very philosophical as traders. So we'll say it's going to hold until it doesn't. How about that one? So here we have here's our first touch. In and of itself, that means absolutely nothing. Price breaks through, false breakout, it pulls right back down. We pull through again, and lo and behold, we've got another one. If we wanted to, we could put this one in, and look at that. 2 points make a line. Remember that from our geometry class. Here's 1, here's 2. Now, we have consecutive candles here and here. Here's 2 candles, here's 3 candles touching this line. And you can say, well, doesn't that count as more touches? And the answer is no. These 2 candles would count as one touch because they are consecutive. We need price to pull away and then pull back in. So now we've got 1, 2, 3 candles in concession. That counts as the second touch. Now, if we wanted to, we could put that line across. And if we were over here like so, and we had this line up there, and as we get close to like right there, we say, oh, we're stopping here. Now, we're at resistance right here with this green candle at my right edge. We don't know whether price is going to reject, such as it has done so many times in the past, or if it's going to break this line of resistance and continue higher to whatever degree. We have to wait. But what information does this line or these lines tell us? Well, it tells us that price has rejected this in the past, and being philosophical, it might reject once again. Now, because this is my hard-earned money on the table, and I see this type of setup on my chart that I'm looking at, I am not, again, this is how I would trade. I would not place a trade. I would not buy this market to the long side, thinking that I could get up here to this red dash line. I'm just not going to take that risk. There's too much potential that it might, no guarantee, it might pull back. Okay, so that's how I would use this line right now. Well, lo and behold, it did break through, but it came up and held at this line. Now, I've got 1, 2, and a whole bunch of other candles just bouncing off of this resistance line. Once again, am I going to take a trade thinking that I can get up to this red dash line, dotted line, whatever you want, a dotted line, I guess? No, I'm going to wait. Now, once it breaks through, right there on that candle, now, theoretically, I don't know if this holds true, but for our sake of argument, we're going to say that I'm in blue sky territory, and maybe I could take this further. Now, what's the program today? Program is talking about breakouts. Well, here is a consolidation. Did we break out? No, we broke to the downside. This was in an uptrend. If this trend were to continue, obviously we would be breaking through our lines of resistance. Instead, it just broke through one and held again. Now it broke again. Could we trade that? Yes. Could we have traded this first one? We could, but having this line there, we are suspicious that maybe price could hold at that resistance line, which it, in this case, obviously did. Now we've broken again. So on this candle, now this is a daily chart. So on this day, when price broke above this line, we could have taken that trade and said, okay, I've got my moving averages. Here's the 10 in black, 20 in blue, 50 in red. They're in the proper alignment. In an uptrend, you want the 10 above the 20, 20 above the 50. This is the 200 down here. I'm more concerned with these three. When those are in the proper alignment, it says that we have a quality trend. Mirror image, in a downtrend, speaking only of moving averages now, the 10 is below the 20 is below the 50. That is a quality downtrend. So we would only trade to the downside. Now we're only going to trade to the upside because we have our moving averages in this alignment. So we could have traded this breakout to the upside. And we could have gained a good trade right there. Now, we have two support and resistance lines in place. Previously, we had been talking about stop losses. What about stop losses? Always, always use a stop loss. Hang on a second. I'm trying to lubricate my vocal cords. So, speaking of stop loss, let's expand this a little bit. We're going on this nice big green candle. When we break above here, actually, I guess now that we see this a little better, we can move that up a little bit. There's a better, because we have these lines going up a little higher. It didn't there, but it did now. Okay, that's better. Now that we can see it. So on this big green candle, when we break above our resistance line, we could enter a long trade because everything looks, from a price action perspective, everything looks like it was going to go in our way. And Obviously it did. Pardon me. Even within this one day, if we were a short-term trader, and two styles of trading. There is day trading, where you're in and out of a particular position within that day, or a swing trader, where you're holding your positions for a few days, a few months, or a few weeks rather, excuse me, a few days, a few weeks. That's a swing trade. No right or wrong. It's just whatever your personality and style of trading is the type that you would do. If you were a day trader, you would have had a very nice trade with this particular setup. Holding it for a swing trade, again, you would have a very nice setup and potential for wonderful profits in this type of setup. Stop loss. So once it breaks through here, support becomes resistance, resistance becomes support. Under here, this line is resistance. It breaks through. Now price is here. This line is support. It was resistance, becomes support. What does that mean? It means that this line acts like a barrier, potentially preventing price from breaking through to the downside. Look what happened on this green candle. Right to the touch. Perfect. It held. So where would we put our stop loss in this scenario? We would put it down here below this, just below this line, whatever your strategy is. So that's how we could use our support and resistance line in this example. Okay, let's see, check my notes here, see what else is going on. All right, that's good. Let me squeeze this back down. That looks good there. There we go. All right. I recommend looking at multiple time frames before you place a trade. So I'm going to go to the higher time frame on the weekly chart. Oops, get up here. Get up there. There we go. Okay, good. Oops. There we go. That looks good. All right. Now, notice that our support and resistance lines carry over. Now, on this time frame, this lower one doesn't do a lot, so I'm going to click on there and just get rid of it just for simplicity purposes. But lo and behold, look what we have on this time frame as well. Here's that candle that broke out from the other support and resistance line. On this time frame, what do we have? We have a consolidation. Here's our resistance line holding here, 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 and then on this green candle, we have our breakout. Is this an uptrend? Yeah, 10, 20, 50. Here's a bonus. Look at where our lows are. Now we know that an uptrend is higher highs, higher lows. In this type of consolidation where price is rejecting from this flat line, can you have higher highs? Well, no, it's stopping at the line. But you can have higher lows, and that's what we have right here. So we are consolidating in this. We're getting ready for a breakout. We have our resistance line up here. We're squeezing, 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 getting in close. 10, 20, 50, we're good. And then right here on this green candle, we broke out. Beautiful trade. If you were trading this particular time frame, you could trade that. And here's an example of, let me get rid of that. There we go. Of why you want to have a profit target. Just as an example, and I'm not suggesting how you do this or where you do this or what have you. But and I'll show you another example as well. Hypothetically, let's say that your price target was 159.5, or yeah, 159. So right there or so, that was your price target. And I'm making this up, folks. This is not meant to suggest anything. I'm just making an example. If your profit target was 159.5 and you put that into the system, into the platform that you said, I want to exit my target at 159.5. Look at the beauty of that. It hits 159.5. It actually goes a little higher. And then what happens? It plummets. But because you utilized a profit order, you were able to maximize your profit on this example, on this trade. Here's another example. Here's using, hypothetically, if this support line or support resistance line here was in place, and obviously it wouldn't be because this is where it started, but let's pretend that it was. And you recognize that price may not go above that line, but you're long in here for a position. You said, well, if price gets close to this, I'm going to take my profits at that point and not risk it rejecting and coming back down. It may go higher, but I'm going to say right there is my profit. Boom. You hit your profit, market goes down, you got out, you maximized your profit on that particular trade. Okay, so that's what I wanted to share with you on this market. Let's go elsewhere. Let's go to euro dollar. Let's expect the daily chart. I use the daily chart just because I'm assuming that many of you are utilizing the daily chart. Now, there's no right or wrong. I'm not suggesting that you do. Again, I'm just assuming that many of you do. So I'm trying to utilize that time frame that is comfortable to you. Okay, now, if you are a trend trader, meaning you only trade with the trend, either upside or downside, whichever, this is a prime example of an ugly chart. And you say, why is it ugly? Well, here's the 50 kind of coming through. That's the smoother moving average. Price goes up, comes down, goes up, goes down. It crisscrosses through there. That's not a trend. That is ugly. Not saying that on the lower time frames you couldn't trade something in there, but as a trend trader looking for a trend in there, that is ugly. And it's not nice to use ugly terms, but I'm talking about a chart, so I think it's okay. Here's a support and resistance line. Let me put another one. Here's another one, right about there. Now we have a different picture, don't we? Now we can see that price is holding here. It's holding here. It broke down. Yes, it broke through there, but it pulled right down quickly. Came back to retest on that red candle and that red candle and held. Came back down. Yeah, a little false breakout there, but nothing serious. It did hold. Came back, almost made it. And again, when you see, that's why you need to be prepared to exit your trade when you get close to these support and resistance lines. So hypothetically, if you anticipated this coming back and going down, and on this red candle, you were smart enough to go short, and I'm not suggesting that you automatically do that, but hypothetically, again, you could use this lower support line as a profit target. That's the only thing I'm trying to illustrate. It pulls back up. Now we have the potential for a trend, It broke through. Look at this retest. We're holding where? Right at that resistance line, because price is below the line, so the line becomes resistance. Support becomes resistance. We're holding. Where are we going from here? I don't know. I'm just showing you that it is holding. Is this consolidating? Yes. If this breaks through, could we go higher? Yes. Could this break to the downside? Yes. Look at this. We were down here before, so it's not unreasonable to think that maybe price could go lower, but we were also above, so it's not unreasonable to think price could go higher. We don't know. In this example, could we use our indicators? The answer is yes. I use RSI and MACD. RSI stands for Relative Strength Index. MACD stands for Moving Average Convergence Divergence. RSI is an oscillator. It moves back and forth within a range. It goes from 0 to 100. It cannot go higher, it cannot go lower. The shaded area is at 70 and 30. That is how it is initially designed. As you can see right there, there's 30, and come on, there's 70. There we go. MACD also moves back and forth, but does not have the restrictions of a range. It can go negative down below this zero line that you see here, or positive. And as you will see on various time frames and various charts, you will see varying values for MACD. How do I use it? Here's from a price perspective, price action. This is in a downtrend, lower lows, lower highs. I look at our indicator. When price action makes a new low, is the indicator also making a new low? Yes. Here's a new low, here's a new low. This is telling me that this is a quality downtrend, and maybe it's going to continue. So then we look at our moving averages. This 10 is going higher. It hasn't quite crossed, but wouldn't take much for that to cross, would it? So am I automatically going to trade to the downside? No. Pardon me. I would wait for a better setup, but those are the tools that I would utilize to determine whether to take a trade to that direction or not. This, from a price action perspective, is a beautiful downtrend. Let's go to the higher time frame. And this, you look for trends, or people say, well, yeah, I want a long trend. Folks, that's a long trend. This starts in the middle of May or end of May and goes through September of the following year. Or I'm sorry, that same year, pardon me. So what, May through September. That's a long trend. You could get a whole lot out of that. All right. Let's get rid of, well, no, we can keep that in there. Here we have another line down here. Let's put that one in. Right there. Now, what am I looking for when I put up my crosshairs on here? I'm looking for areas that price has rejected a number of times. All right, so now, let's see if I can, let's see, what's this one do? That one's pretty good. Oh, right there. Okay, let's use that. Now, with practice and time, you will also visualize, your mind will tell you where these flat lines are located. All right, let me get rid of this one. Oops, come on. Get rid of you and get rid of you. All right, now what I wanted to share with you on this time frame, look at what price is doing. It came way down, it came up, not quite close to that. I would not call that one a touch. That's a little far away from my judgment, and that's what it is. Now, some of you would say, yeah, that's close enough. Others will say, no, it's not. That is not close to that. This touch, pulled away, that's close enough. That nailed it, came back up, nailed it. They went a little bit beyond, but that's okay. I'd still count that as a touch. So we have, but this is a range. So we have a top of the range, because that pulled back immediately, and the bottom of the range. This is a sideways market so far, as of now, anyway. This shows that slightly bullish move that we saw on the daily chart. Why do I show this? Because at some point, price is going to break out either through the top side or to the downside. This is why I would put my support and resistance lines in place. Whether you want to play within this playground or not, within this sandbox, so to speak, that's up to you and your particular trading style. Again, I'm not here to tell you that. That's up to you. What I am saying, as the name of today's presentation was talking about breakouts, this is a simulation of a breakout at some point. I don't know when, and I don't know direction. It's going to break out to either side. In the meantime, if you're trading up or down, that's up to you. But this higher time frame sees this big picture of here's the sandbox of which we can play. And whether you use that as a profit target, as a stop loss below and above, all opportunities for you in that perspective. Let's see, is there anything else on this one? No, that was good. Okay, let's go to another one. Let's look at pound dollar, Great British Pound, USD. Oh, let's go back to daily. Okay, here's a daily. Let's go look for support and resistance. Let's see. That's pretty close right there. Is that a good one? Yeah, I like that. Right where we are right now. That's just dumb luck that this green line happens to, this green dotted line shows current price, as we see right there. And it's dumb luck that we happen to be at a support and resistance line right now. How about that, folks? Came down there, we stopped. Came down there, we stopped, broke through, retested. It's not 100% of the time that you will see a retest, but it is not uncommon. Came back down, stopped, came back. Here's that retest before going up. Stopped again at support, pulled back, support, pulled way back, pulled way up, came back down, support, came back down, support, broke through. We've retested, and now this market is trying to decide, are we going to go break through our support line, our resistance line rather, or are we going to hold that resistance and break down? We could go either way. We've been there before. Now, how about above? Right there. Let's look at that. Right there. Is this a sideways market? Yeah, I would call it that. We're bouncing between these two guidelines. And now we've broken out. We pull back to it. So was this, I guess this line right, this candle right there, was that a breakout? Yeah. It broke outside of the sandbox. Off to the races. Now, could we have a false breakout here? Yeah. Could we have potentially made some money? Possibly, depending on your trading style and your profit target, maybe. If you traded the breakout, again, up here, if that was your profit target and you put it into the system, potentially you could have had a good trade there before it pulled back. Once it starts to pull back, you want to get out. If you hadn't, your stop loss needs to be somewhere in here to minimize the pain. But then we broke back down, retested this top, broke down again strong, very strongly with that red candle right there, coming down, and then big red candle again. Boy, there's some down days on this market before coming through. Now, here we have our downtrend, our indicators, lower, 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 lower. They're pushing to the downside. It's a big step up. You have a crossover there. There's that 10 period again coming up, getting close once again. Doesn't give you the warm fuzzies that we had right here, that the market could continue to the downside. So we'll have to wait and see what it's going to do. Could this create a new range? Here we go. Look at this. Right there, here. Not like there. Okay. Could we now be in a new playground, the new sandbox? Maybe. I don't know. We've got a nice support and resistance line here, a number of touches, not as strong as this one, but it still qualifies. I don't know. But having these lines on the chart give us information so that we can make a decisive decision, a good trading decision. All right. That is why we put these on the chart. Now, the market is way down here. If I, just for fun, if I go out here like so, oops, come on, there we go. I'm down here. I got this blue line here. I don't see anything that's going to show that blue line. But not unreasonable if price comes back up here at some point. Having this blue line on the chart, which is why I like the horizontal line in both directions, is going to tell me that in the past, this was a support and resistance line, and I need to respect that. So that's why I put them on when I see them, where I see them, what have you. If we go to the weekly chart, what do we see up here? We could add that one in. How about up here? Look at that. By going to the higher time frame, we can see that this was not an aberration. This is a support and resistance line, and it held. And when we go back, we can see, oh, it touched there, it touched there. Wow. Looking here, you don't see that. Going there, you go, oh, I got a lot more touches on that. That means this line is that much stronger. All right. The agenda called for the CAD. Let's just briefly go to the dollar CAD. USD CAD right there. Here's another breakout. Right there. Now, again, we had higher lows coming all the way in. Even though we got this flat line, we're squeezing that in there. Crosshairs. Now, this candle broke the line. So you potentially might have gotten in there even though it pulled back. So what do you do in that scenario? Well, you don't do anything. Why? Your stop loss might be down here as an example. So if price comes up here, or up to here rather, these two red candles, it's okay. We're in the playground. We're in our wiggle room. We're okay. And then boom, 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 off to the races. Beautiful breakout right there. Okay. So I wanted to share that one with you as well. Get rid of those. Okay, excellent. So why should you trade the Forex markets? Well, you can trade 24 hours a day. This is a plus. Depending on your schedule during the day, whether you're working or other things going on, you can find the time to trade. And you can time those, or find rather, you can find those markets that fit what you want. Do you want the quiet time? Do you want the busy time? You can find it because it's 24 hours a day. Pardon me, I'm sorry. And we are working around the world. So Sunday evening, 5 p.m. Eastern to Friday, 5 p.m., you can trade. And you can speculate without ownership. Unlike equities, where you're physically buying shares in that particular company, you can speculate on currencies without owning them. And that means we're talking about the change of price in rising and falling markets. As I've said before, shorting currencies is just as easy as buying them. It is a mirror image. Whatever setup you're looking for in an uptrend, look for it in a downtrend. And you can trade more with less. That means with leverage. So at a 50 to 1 leverage, you can take a larger position with less capital. The caveat, be aware that increased leverage does mean increased risk. So if you need to reach out to forex.com, here it is, the phone number, social media. They do offer spreads as low as 0.2 on commissions, and you can reduce trading costs by up to 18% with rebates. With both of these, conditions obviously apply. And forex.com is a market leader with proven financial strength. That concludes my comments. If you have questions, please go ahead and type them in the question box and I will see what I can do for you. Quiet so far, maybe you got something now. Oh my, got a long one here. Hang on. All right. All right, the question is using the Fibonacci tool. Ruth, from our perspective, of what I wanted to show you today, I mean, I don't have time to get into a full blown out thing of everything that you could do with Fib. Today's lesson was simply to use it within a trend to measure a potential pullback, and using that price of the potential pullback to use that as a possible entry point to go in that, to enter that position or enter that trend with a position. So that's what I would suggest. If you have questions on that part, I will be happy to answer you. Let's see, a long one here. Log charts. I don't use log charts, Paul. Let's see, the fib level markers may shift. The option is toggle. I don't trade, personally, I don't trade log charts, so I am not familiar to give you a good answer. How I shared with you today works well. Nothing's 100%, just a caveat there. But that's all I can tell you. If you have something else to help you there, Paul, or a clarification, I'll be happy to look into that. But again, I'm not I don't use log charts, so I can't give you much of an answer there. Will there be a recording? I believe there is. Don't quote me. If there is recording and they're sending out, you should get that within a day or two, if that's coming out. And another question, can we read a candlestick as well? Absolutely. Candlesticks, and that's why I use candlesticks, however you want to call it, because of the wealth of information that they tell us. So if you're familiar with the candles, yeah, absolutely. Now, caveat, I would utilize candles in conjunction with other technicals. I would not, personal opinion, I would not use them as a standoff alone. But then again, I don't use anything as a standoff alone. I always use something in conjunction with something else. Hopefully that helps you. You are welcome. Let me see, anything else out there? Any other questions? I don't see anything coming through. I'll give you a couple of seconds in case anyone's typing. If I didn't answer your question clearly enough, please come back to me on that. I'll be happy to take another stab at it. Any tips for avoiding false breakouts? Very good question. There are times when we will get fooled. It's just the nature of trading. I don't care what strategy or something you're using, there's going to be something that's going to fool you. And that is why we always use a stop loss. Now, to minimize getting fooled on a false breakout, I would, in addition to the price action, I would look to the indicators, meaning the moving averages, make sure you're in the proper direction, equality, and look at the indicators. Are they doing what they're supposed to be doing for that particular trend? If you are a trend trader, then follow that. Hopefully that helps. We have another question. Lack of volume profile can be an issue in Forex markets. I don't use volume, personal opinion. Some people depend on it, others don't. For me, the concept of volume and the purpose behind using volume is wrapped into the indicators that I use. So I don't miss volume, personal opinion. And if you're a strong for a strong advocate of volume, then yeah, I can see where that might. If it's just a matter of getting used to not having it, then that's another thing as well. Hopefully that helps. You guys had some good questions. All right, I don't see any more coming through. I want to thank everybody for coming out today. I wish you well in your trading endeavors and hope you get to be the type of trader that you wish to become. With that, have a great night, folks. Take care.